is those things come shopping in the listed market for things that were very expensive and are now a bit cheaper. I'm not saying the markets are now looking cheap, they might fall further, but we could see more private equity bids. And when we get exits, we get NAV uplifts, and the whole thing is running on. So all good. That's enough from me. I'm now going to talk to Jonathan Maxwell. And it is. Good morning.
Hi, James. Hi, how are you? Good morning.
All right, thank you. Thanks very much for doing this again. So I was trying to remember when we had you on last time. It was about a year ago. So really, I think we just want to have a look at how the fund's progressed since then. But I think it's probably best to start off with just a recap of what the fund's trying to achieve and how you're going about it, please.
Absolutely. Well, thanks for putting the presentation up on the screen, James. I hope everybody can see that. These are some slides extracted from our interim results presentation, which we gave on the 10th of December last year. But it's still a month on, broadly in line. So just to answer your question, James, just to set everything into context a little bit, SDCL Energy Efficiency Income Trust, or SEIT, was the first dedicated energy efficiency investment trust on the London Stock Exchange. One of the things that changed, James, since we saw you last year, was delighted to say that it's now been admitted to the FTSE 250 index, and it has just over £1 billion market capitalisation. So it's done well and grown quickly since IPO in 2018. But before I get into it, what is energy efficiency? It's obviously I think an emerging segment of the infrastructure sector. But what I'd like to start off with is why, why energy efficiency is going to be one of the most important themes in energy-related investment for the next decade, let alone an interesting opportunity for investment through an investment trust like this one. So just to put that into context, we just in late November, early December had the climate change conference, the UN climate change conference in Glasgow, COP26. So some of the last words that went in from our perspective were some of the most important, went into the Glasgow Climate Pact, which was the document that came out of the COP26 event. So the Glasgow Climate Pact, extremely importantly, for the first time, explicitly called for energy efficiency alongside clean power generation in order to meet carbon emission reduction targets. This is it's a very, very important statement, because what we've seen, definitely at regional level in Europe and in the United States, and now on a global level, is a real acknowledgement that energy efficiency it needs to have its space, and now does, at the absolute top table of decarbonisation plans and solutions for the next decade. Why? There's a fundamental problem with the energy system, and the first statement here sums it up. We're wasting somewhere in the global energy system, somewhere between 2/3 and 3/4 of the energy, the original energy, somewhere through the generation, transmission, distribution, or end use of energy. It's a huge problem, dislocation, and fracture in the energy system. And candidly, without solving that problem, very difficult to see how the world meets its 2030 carbon emission reduction targets or gets anywhere close to 1.5 degree implied temperature rise, which is the limit considered safe by scientists and governments. So, our point of view there is that if 2/3 to 3/4 of energy is being wasted, what about the cost? There are two types of cost. One is energy is worth trillions of dollars. So if 2/3, 3/4 of it's being wasted, that implies wastage of trillions of dollars annually of energy. The second is carbon. And here we are trying to create renewable power to create lower carbon energy solutions. But of course, what we've got in the energy system is enormous amounts of carbon being wasted in the first place. So that's what energy efficiency is about. It's about addressing one of the biggest problems in the energy system and one of the most valuable problems in the energy system. To start with the size before we come on to the value, energy efficiency is probably, it's not all, but it's probably up to half, maybe even more than half of the decarbonisation opportunity for the energy system. To date, all of the focus substantially has gone into clean power generation, which is to be celebrated. In fact, it needs to be tripled by the end of the decade if we're going to get to global targets on carbon and implied temperature rise. But there's another side to the coin, and energy efficiency is the other side of the coin. How do we stop the energy wastage in the system? The International Energy Agency actually says that energy efficiency represents more than 40%. This is their number of the emissions abatement needed by 2040. And the difference that energy efficiency can offer is actually that it's deliverable and profitable, because you're saving money as well as carbon. It's profitable. And the last point I'd make on the deliverability at this point is that the technology exists today. We do not have to wait for it to be invented. It's readily available, widely tested and successful. So energy efficiency is moving now into the center stage alongside commitments to cut emissions, deforestation, coal, petrol, diesel cars. You're going to hear a lot more about energy efficiency, certainly from us, but much more from government companies worldwide. In fact, the International Energy Agency sums it up nicely. Fatih Birol, Executive Director, we consider energy efficiency to be the first fuel. It represents the cleanest and in most cases the cheapest way to meet our energy needs. So, James, I think we've just extracted a few slides, as I said, from the September results, and then perhaps we can open up to a discussion. But I'm pleased to say that, while See It is targeting, for the reasons I've explained, I think one of the most important parts of the energy system. It's making money in doing so. From a performance perspective, the NAV per share in the 6-month period that we were reporting on here in December related to March to September was up to 104.5p, up 2%. Our total return since IPO on an NAV basis is 7.1%, in line with our targets. Dividends are covered by earnings and cash. So we have a 5.625p dividend target for this year, and we declared half of that, paid semi-annually, related to that first period at 2.81p, which is up a bit from last year, and that dividend is covered by earnings and cash. Shareholder total returns since IPO have been strong and generally outpaced the main market. Scale is important. When we launched the company, See It, back in December 2018, the IPO was £100 million. Very proud to say that the gross asset value, as at that last valuation, had achieved just shy of £1 billion, and the market capitalisation just a bit north of £1 billion, so 10x in 3 years. When we're reporting in September, or in relation to the period to September, we're also pointing out that we had a £250 million oversubscribed placing in September last year. So we thank our shareholders, I'm sure some of whom are on the line today, for the support there. Alongside
the ambition is to carry on expanding. What sort of pace do you think you can achieve for that?
So we did the IPO at 100 million in December 2018. In round numbers, it's £1 billion today, which implies around £300 million a year of investment over the course of the last 2 to 3 years. I would expect that there's certainly no slowdown, James, on our pipeline. I think the priority for us is to make sure that we are getting the most out of the investments that we've already made, number one. Number two, we have a pretty substantial follow-on or organic pipeline, because the portfolio now has critical mass. There are additional opportunities that come up, to repeat or to follow on with investments that we've already made. And then the third is to find attractive NAV and earnings enhancing acquisitions out there in the market. And we'll be doing all three of those things, but those are the priorities. It's not growth for growth's sake, James, but absolutely we see opportunities for a continued expansion of the portfolio. Mm-hmm. On that point, in terms of investment activity, very consistent what I've just said with what happened last year. So in the 6 months between March 2021 and September 2021, we made I think it was 14 deals. A number of them were new investments and follow-on commitments. during that 6-month period. So 9 during that period, 5 new investments and 4 follow-on investments. And then in the period from September to when we were reporting on that period in December, we made another 5 investments, 2 new ones and 3 follow-on. So, against the 250 million that we raised in September, we were also reporting on a deployment of approximately the same level. From a sort of competitive advantage perspective, when we started See It, it was the first of a kind. There have been other trusts, which I'm pleased to say, have come into the market because it's a growing segment. But we do have the benefit now in See It of a consistent track record of delivering returns and investing capital. And we've been doing this for a long time. At SDCL, I run SDCL, and we're the manager of See It. We've been investing in energy efficiency projects, in fact, developing and investing in them for a decade. So, coming at this with a long heritage and looking to really allow See It to benefit from that for the next decade too. Last point I'd make is, in addition to returns, is from a financial perspective, is from an environmental perspective. So we published an ESG report in November 2021, which we like to do annually. But that describes everything that we do from a carbon emission reduction, job creation, and other kind of environmental, social benefits that come out of energy efficiency. Energy efficiency, in my view, is the biggest bang for the buck from a carbon emission reduction perspective. So the climate and pollution benefits are very substantial, but we also report, of course, on the social benefits generated. Perhaps we could just move on to the next slide. We obviously make the point here that we welcomed a 5th director onto the board, which is well governed. But just looking at the overall performance here since the IPO in December 2018, you'll see quite a bit of activity. The blue boxes actually relate to capital that we raised subsequent to the IPO. The rest of the marks there relate to investments that we've made since IPO. So we're investing regularly, as I said, both in follow-on investments and in new acquisitions. And we've been hitting our numbers in terms of earnings per share and NAV and growth. Just moving on to the next few slides and then absolutely open up for a discussion, James. But moving on to the next few slides. One of the important things for us as we've been able to grow the company is to ensure that not only are we meeting our EPS and NAV targets, but that we are also consistently, growing, increasing marketability, liquidity for our shareholders, but diversifying the underlying portfolio. And we look at diversification through a number of different lenses. Of course, there is the standard and simple one, which is making sure that our portfolio is adequately diversified from a project basis. So that's the first analysis here, with 15% roughly in the largest project and then the smaller ones coming off the back of it. From a technology perspective, we also want diversification of technology. The very interesting thing about energy efficiency is that we're solving fundamentally one problem, which is energy wastage, but the solutions to those problems are very varied. It really depends on the local circumstances. So, energy efficiency is really about delivering energy solutions that cut cost carbon and improve reliability for end users. You get that single problem about energy wastage applies differently to different end users. 70% of the world's energy is used by buildings, industry, and transport, and obviously they differ in their needs, in their locations, and so on, and therefore the solutions to their problems differ. From a technology perspective, depending on where they are. So there are some great examples here in areas where it's sunny and there's availability of that sort of resource and it makes commercial sense. We've done solar and storage. In areas which are harder to reach, we've used high efficient, what we call combined heat and power. In some circumstances, those combined heat and power projects are fueled by different types of gases. We have a very, very substantial position, leading position really in what we call green gases. So those are waste gases, fugitive gases coming off of blast furnaces, where we use that to drive turbines to make power and steam for steel mills. In those particular locations, it's hard to deliver high temperature heat and certainly the wind and solar resource wouldn't do that. So we have to use other mechanisms or other fuels, and actually using the waste gases from steel mills is a fabulous way of reducing pollution and improving supply. So, different types of technologies in different circumstances. That's why you'll see a hugely diversified range of underlying technology applications, which is great for the portfolio. But remember, we're really solving that one problem, which is energy wastage. On the next slide, country exposure, around 50%, just over, is now in the United States. It's obviously a very large, but also very exciting market for energy efficiency. Europe, 23%, and we expect to grow, and also the UK, which is also a growing market for SEEIT, currently 7%, but we expect that to expand, particularly given some of the activity going on right now on the electric vehicle charging infrastructure that we're supporting. On the bottom chart there, life cycle, going back to my original comments and the name of the company, SDCL Energy Efficiency Income Trust, we're very focused on covering our dividend targets with cash and earnings, and on that basis, life cycle follows. So if we look at our invested capital, the bulk of it is in existing operating assets that throw off cash that can then contribute to our earnings and cash cover for our dividends. So of the total assets, as at the date we published this document, 70%, but most of the portfolio was on operations already yielding. 7% was in construction, and investments that we make in construction for SEEIT generally should yield within a year or so, so relatively quick to turn into cash, and then a small proportion of it in development. Just moving on to the next slide.
And then just to check, so you get NAV uplifts when these things are completed and operating, is that true?
Part of the rationale for investing at development and construction phases, as you say, is to be able to benefit from the profit associated with going into projects earlier than operational phase. And yes, one of the consequences of that, is the opportunity for some NAV growth.
Cool. Okay.
Could have said yes, couldn't I, James? I think one of the other features of having a sort of long-term operational portfolio and a real focus on that, even when we're going into projects in construction, we're very clear that we have a contract in place, that will give us, recurring, contracted and predictable revenues. The consequence of that is that we're then able to make some projections of what our future cash flows are going to look like from our portfolio, and therefore, position the portfolio construction and indeed, the financing of the business to make sure that we're covering our dividends to shareholders and dividend projections and a progressive dividend policy. So that's really what this chart is showing. Put all of our portfolio together, what does that revenue stream look like over the next 10 to 15 years? And then now how do the cash flows coming back from the portfolio relate to the dividends that we're targeting to pay, and indeed a progressive policy around them. So hopefully business continue to support a progressive dividend policy.
Within your revenue mix, how much is the portfolios? It's got kind of inflation linkage to the revenue pattern.
Thank you for the question. So these days, a pretty good proportion of it. I think the number that we gave at the this interim results presentation, I think was just north of 50%. Some way north of half of our revenues are associated with inflation or correlated in some way to inflation. So that's broadly how the portfolio is positioned. That's different from where we were 3 years ago. So when we did the IPO, the portfolio construction was fundamentally had a predetermined, generally increasing, but mostly increasing on a fixed basis revenue. And over the course of the last 2 to 3 years, we've tilted the portfolio towards having revenues that would increase in line with inflation. So it's probably just more than half, James, at the moment.
Good. Okay.
So 6 key numbers that we reported on, and I think you sort of got the message from me. What our objectives really is to deliver investors what we said we were going to do. So we aggregate dividends declared for the 6 months were up and covered by earnings and cash on the top line, and then from a profitability perspective, the company doing well, on track for a very good year. For the year end March 2022, which is nearly upon us. NAV increasing, roughly 950 at the last count, which related to about 104.5p per share at the end of September.
Great. Okay. So the next couple of slides are just individual projects and stuff within the portfolio. I think that's going to be quite interesting to delve into some of those. But just on the kind of big picture thing, one of the things that I've maybe could be a bit confused about, and actually one of the questions here is about the degree to which the portfolio's energy efficiency and the degree to which it's actually just generation, and is just generation a bad thing, or is that is it going away from what you were set up to do?
Great. Well, thanks very much for the question. So this slide is actually the perfect one to try and describe what we mean by energy efficiency. So the problem we're trying to solve, as I said, is energy wastage, and it's energy wastage related to customers. So the bulk of the way in which the energy system has been serviced or built around really over the last decades has been a centralized system, going back to the days of oil and gas and then into the more modern era of independent power producers and renewables. The focus, really, the largest amount of the focus from a capital and certainly capital markets perspective has been investing in grid-connected renewables and grid-connected energy projects. And that is, I think, if you like, the classic supply side or generation model. But our point is that the grid, while that is incredibly important, there is another side of the coin, not just the centralized grid system, but of course the end user, which is, as I said, 70% of energy used by buildings, industry, and transport. So the difference is that here in SEIT's portfolio, we're more often providing energy generation or other energy services like efficiency directly to the end user. So the business model is less about selling power to the grid or energy to the grid. It's more about providing energy directly to the end user and energy services. And that happens in one of 3 ways. So on the generation side, on the demand side, and on the distribution side. So let's start on generation. So, the examples that we've given here, Onyx, Primary Energy, and Oliver, the thing that really sort of makes them all the thing that's consistent, most consistency, is that they're generating energy, but they're generating a very large proportion, if not all of the energy, directly for an end user that is close to or right where the energy is being generated itself. So it's not going through the grid. It's going directly to the customer. And it's a huge difference. If you take the largest component of the energy mix traditionally in major markets is gas, and if you take a gas turbine and you fuel it with gas, if it's a centralized plant plugged into the grid, typically it's operating at or below 50% efficiency. The reason is that when you put gas into a power plant like a turbine, you're producing 2 things: power, but also heat. And if the generation is happening well away from where the energy is going to be used, there's nothing you can do with the heat. So it gets dumped. So you get huge losses, energy losses, thermal losses at the point of generation. And the difference with what we're doing with this portfolio is we're investing in projects, whether they're driven by natural gas or even green gases or waste gases. We're investing in projects that generate energy at or close to the point of use. So instead of that heat being dumped or wasted, instead it can be used for high temperature process, steam or heat solutions. And if I sort of go through 2 examples of that, Primary Energy is exactly like that. It doesn't produce power for the grid as its business model. It's turbines on site at steel mills, fueled for the largest part by waste gases coming out of the steel mills and producing power, as turbines usually do, but using the heat for steam for the steel mills again. So it's a closed loop highly efficient system, which is much cheaper and cleaner and more reliable than traditional grid systems. See at Oliver on the right-hand side, again, we call this cogeneration projects. We're using turbines to create power and heat, and the heat there is being used directly for the olive industry and agricultural use in Spain. And then it's not just turbines. As I said, the solution depends on where the problem is. So on the left-hand side there at the top left, Onyx, to use your phrase, James, that's just generation, yes, but it's not generating to the grid, it's generating directly to the end customer. So these are projects on rooftops, on carports, on ground mount, but directly connected to buildings. So we've got over 200 on-site solar and storage projects in the United States through a platform called Onyx, which is one of the top 10 deliverers of solar and storage in the United States for commercial and industrial customers. So that's really the difference. When we're generating, we're not generating as a primary business model, typically to go to the grid, but we're generating to provide energy services to an end user at or close to the point of use. So that's what ties.
Because you're doing it that way, does that mean does that cushion you from gyrations in power prices?
Very, very much, yes. So the other feature of these projects is that because we're selling the energy service, whether it's the power or the heat or some derivative of it to the end customer, we're typically doing that first of all on a contracted basis. It's not a merchant power business, so it's contracted. The second thing is that those contracts are typically on a predetermined rate. So the rate is agreed up front. And then therefore, over the period of time, we can have a stable and predictable revenue stream. In See at Oliver, it has those characteristics. There are, in fact, there's a sort of equivalent form of CFD we could get back from the government to deal with any short-term volatility in any revenues for us over the medium to long run, but. Yes, the answer is that we take little or no in a lot of these deals exposure to market prices, and we also try and avoid exposure to demand risk. What we're trying to do here is invest in projects where we can get paid to make energy services available for use with relatively low, if any, exposure to power prices and relatively low, if any, exposure to the demand of the customer. So absolutely, James, it's designed to create sort of a insulation against power price movements. You won't have seen a significant impact on our NAV from those two factors, which obviously have been a feature for quite a lot of the rest of the market. So that's the supply side, what you call just generation. On the demand side, what we call energy efficiency, there are things that you can do to save energy at the point of use. So, I said roughly 3/4 of energy gets lost before it gets to where it's needed. The tragedy is another 20-30% can get lost by buildings. And there are solutions to those problems, like changing lights, heating, ventilation, air conditioning, motors, controls. And again, what we're doing here is investing in projects with a contract to deliver energy services. So think of like a lighting concession for Santander Bank. We've recently invested in a portfolio of about 1,000 very small lighting concessions. So again, predictable revenues, predetermined rates, under contract with end clients, so that we can assess the revenue streams and also mitigate any risk around that from a performance or credit perspective. And then the last point I'd make is that sometimes there's a gap in between supply and demand. In other words, that you have to look at distribution. And sometimes energy can't be generated exactly where it's needed, so that you need to distribute it somehow. And so there are projects within our portfolio that do that and do it efficiently. So a great example actually is Gasnetet, or what we're now calling Vattengas, which a very large part of that takes waste gases off of water treatment plants in Stockholm. This is Stockholm's gas grid, by the way. Take the wastewater treatment waste gases, and they're then piped as biogas to commercial, industrial, residential, and transport customers. Over 50,000 of them actually in Stockholm. And again, that's a sort of concession style fixed tariff. Of course, there are some. We have a Venn diagram here, so there are some projects that do more than one of those jobs: supply, demand, and distribution. Red Rochester is a very large district energy network that we invested in towards the beginning of last year. That's got 106 customers across the second biggest business park in the United States. It's about 10 kilometers across, and we own the district energy system that provides 16 utility services, mostly though about power and heat to those underlying customers. And again, we get a predetermined contracted return profile coming back from the investment in that project.
Great. That's all quite comprehensive. Maybe we should look at a couple into slightly more detail. I just want to think. One thing I keep getting questions about here is anaerobic digestion. Is this what Biotown's doing?
It's a component of it. It's probably the most interesting thing about Biotown actually is that it's playing into not the power sector, which is often how these sorts of projects can work, but actually playing into the transport sector. So what it's doing is it's taking what otherwise would be high emission agricultural waste with methane fugitive emissions, and it's capturing those, upgrading them, and generating a green gas. Traditionally, quite often you hear about AD projects where you're taking the gas to turn an engine to make power. In this particular case, a very large part of it is actually taking gas to inject onto the gas grid. Why? Because what you're doing is injecting green gas into the gas grid. And there is a market, particularly in the United States, particularly driven by California, for green gas. So there is an opportunity to generate green gas injected onto the gas grid and get paid under long-term offtake agreements by what's actually the low carbon transport fuel market in California. So it's a very, very interesting growing marketplace. That's actually what Biotown Ag is about. It's about stopping hugely polluting waste on farms and turning it into green gas for transport. So it's a really exciting story actually. But some of the other deals we did during the course of this period we pulled out here. So I think just to call out some of the ones that are a bit more interesting, Tala Hospital is one of Ireland's largest hospitals, and we invested in the retrofit, absolutely holistic retrofit, where we're changing pretty much everything about the generation on site, as well as all the energy equipment inside of the hospital and making it more efficient. So that's really exciting. We did a very small deal in North America, actually in Seattle, which is adequately boring to generate the capital and income we need for it, but it's very exciting from a strategic perspective because it's investing in the energy efficient solutions that make actually what will be the world's first fully certified net zero carbon block of flats, as they call them, multifamily properties in the United States. So we're really excited about that. Primary energy. We're really excited about an old story for us. We acquired Primary Energy a couple of years ago, but we acquired it with the option. We acquired 50% with the option to acquire the rest of it over time, which we were very proud to have been able to complete once it got a bit bigger in the end of September. So we now own 100% of Primary Energy. That was the steel mill, energy recycling using the waste gases. And then back end of the year, we acquired a portfolio over 1,000 lighting as a service, as I said, lighting concessions across the US. So those are the three key things. The generation should be much cheaper, much cleaner, and much more reliable than the grid. So where we can do that, we think we're making a huge impact, not just making money, but also really helping to address a very substantial component of the decarbonisation of energy supply that's needed. The second area is about energy demand reduction, and that is just taking carbon out of the demand side. There is no such thing as zero carbon energy generation, but there is such a thing as taking energy demand out of the system, or what we describe as negawatts of energy rather than megawatts. And then, of course, the distribution networks. How do we get clean energy where it's needed as efficiently as possible? And those are the kind of solutions we're talking about in district energy projects, the Stockholm grid and other projects.
Some of these are quite sort of complex and some of them are quite sort of bitty. How do you actually sort of keep track of what's going on and monitor stuff? How much is that of what the portfolio kind of asset management stuff is outsourced?
Yeah, so some of the projects are very simple and mechanical. So at the simpler end of it, if you install the lighting concession, that's pretty straightforward. At the other end of it, you might have a significant energy generation portfolio like we do up in Indiana, serving the steel mills, where we've got turbines recycling the energy. So in the simpler projects, as I said, it's relatively straightforward. In some cases, we have portfolio teams that look after those project companies. However, the more people-intensive side of it does come when you've got an energy plant running on an industrial facility or on a business park. So, if we put the entire portfolio together, there's over 55,000 underlying properties that this portfolio is connected to. That's overseen on the ground by just over 300 full-time employees at project company level across the various different project companies in SEEIT's portfolio. And then there's 45 professionals at SDCL as a fund manager. And we look after everything from origination, execution, asset management, and so on.
Okay. So a few sort of specific questions about projects. Spanish olives. How does that project work? Presumably you're not growing these in greenhouses. You are, right, you're burning the waste. What are you doing with the heat?
So years ago, if I said in a nutshell, years ago, the Spanish government wanted to do something about the problem I talked about a few minutes ago. In other words, you put a big, centralized, gas turbine in the countryside, generate power for the grid, which is needed for these days for balancing, then for baseload, and then you dump the heat. So instead, years ago, the Spanish government actually started a program to encourage energy to be generated much closer to where it was needed. So there's a significant program to encourage cogeneration, high efficient cogeneration, because if you use the heat, you could operate at well above 65-70% combined electrical or thermal efficiency, compared to maybe half that on the grid. That was the idea. So in the Oliver project, what we've done is invest in actually 9 underlying projects. The answer to your question is those projects where they're generating energy, they're generating 2 things. They're generating heat and power. The heat that would otherwise normally just be dumped is not dumped. It's used by the olive oil manufacturers between Jaén and Cordoba in southern Spain. So when they need heat to dry the olives and the processing of those olives, then they're taking that from us. So that's where the heat is going. The power is going onto the grid, but because we're using the heat for manufacturing process and it qualifies as high efficiency as a result of that, because it's so much more efficient than having dumped the heat, we get a market incentive from the Spanish government that is designed to give us a stable, predictable return over the long run. So that's how that project works. We're basically using the heat for the olive oil manufacturers.
One of the things I think about energy efficiency is kind of like insulating houses and double glazing and that sort of stuff. Is there any way of investing in that kind of area?
Well, the very small project I pointed out before that we've done in America, that multifamily apartment block or block of flats, is exactly answering that question. So, what we've done is we've provided investment. It's in the middle, sustainable living innovations, and that's designed to provide the financing for the bits of the building. In this particular case, it's a new apartment block, but the bits of the building which are the energy efficiency solution. So it's all the utility infrastructure, it's the solar, it's the controls, it's the there are some sort of management systems, some of which are digital, some of which are physical, including but not limited to things like insulation. So yes, that's part of it. The problem with residential and getting scale in residential and energy efficiency is, I'm not saying it's not a solvable problem, but what we're typically looking for is a 10 to 15 year contract with a very high quality counterparty that can pay the revenues under that contract from a credit perspective. So what we like is most of our clients to be investment grade, most of them to be, all of them to be essential to their economies in terms of the service they're providing. So high credit standing for the revenue streams, contracted deals over a 10 to 15 year period. and getting some form of scale. And those features are more challenging to find generally in the residential market. Although I think this is a very good example of some of the ways in which we may be able to deploy into residential. We also have, on the insulation is one side of the coin, heating is another side of the coin, and indeed we have a lot of heat customers using our biogas in Stockholm. But yes, I mean, buildings efficiency is a huge part of the decarbonisation story, and residential is a big part of it too.
There was a question right at the beginning before we got started about what your pipeline looks like.
Yes.
Which might be a good way of actually sort of finishing off, really.
Thank you. Yeah. Well, I say the pipeline looks has two looks to it, really. One look is that, after having invested in, I'm delighted to say, £1 billion the portfolio today, one source of pipeline or deal flow is literally just follow-on investments from existing projects that we've invested in. So, if we buy a district energy network, what new capacity can we add to drive revenues? What projects can we invest in that can help to, reduce costs? So, we've been taking actions like that across our portfolio, and we'll be reporting on some of the outcomes of that at the next reporting point for the financial year end is 31st of March. So follow-on investments, we've made commitments. You mentioned with Standard Life Private Equity, actually, their style of making a commitment and then having that drawn down over time. So we have indeed made commitments to various frameworks. So a great example is the electric vehicle network, where we provided a initial 50, but it's up to £200 million framework funding for electric vehicle charging as a service, where our customer is not the retail customer, but is BP, Pulse, Electricity Strategy Board, so in other words, the charge point operator. And we're entering into up to 20-year infrastructure concessions to provide them with the sites and infrastructure they need to be able to offer electrification services to their customers. So, we made that framework commitment, but that will be drawn down over time. So the organic, what we call organic pipeline like that, where we get follow-on opportunities with existing projects or frameworks drawing capital from us over time. That's one, probably by number, half of the sorts of deals we do. The other half of the deals is that we are constantly in the market looking for attractive acquisition opportunities. We're very selective. We produced a slide for our results presentation showing it's about 15% of all the deals we take really seriously, 15%, were actually traded on during the last year. That's a relatively small number because we're selective in what we focus on in the first place. But we do see attractive opportunities, and we're working on a substantial pipeline of them. Right now, this is a very, very large market. When I talked at the beginning about 2/3 of the world's energy being wasted, that's trillions of dollars of value. And there is a big market building up to solve that problem. So, I'm very pleased to say that we've got a very healthy pipeline. We said here over 500 million, over the near term. But, you can expect to see a reasonable proportion of that coming through shortly.
Great. Thank you very much for that, Jonathan. I think it's a good tour around the company. I mean, there's lots of things we could talk about. There's questions all about sort of hydrogen and all sorts of things, but we probably haven't got time to do that now. But thank you for doing that, and we'll sort of follow the progress with interest, and we'll maybe get you on again in another year's time.
Well, delighted, and I'm happy to answer the question about new technologies coming into the portfolio, which may well include hydrogen. So I can't wait, James. Thank you for your input.
Okay, great. Thank you very much.
Thank you.
There's the legal stuff, all very important. So next week, topical because of what's going on with inflation, we've got Sebastian Lyon coming on from Personal Assets, because obviously got very strong views about that topic. On the 11th, we've got the portfolio manager of CC Japan Income and Growth, and that's a kind of income biased Japanese fund that's been doing much better relatively recently. And then he'll be followed the week after by Carl Hardenberg, who's the manager of Mobius Investment Trust, which had a great run in 2021. We are kicking off our new series of webinars on the 24th of February, and I'll give you more information about those next week. But they'll be on a sort of series of days themed. I think the first one might be America, but I can't remember. But we'll have to say, I'll give you more information next week. We've also got the manager of CQS New City High Yield on 25th of February. He's interesting chap, and I think Matt's talking to him, and that's going to be a good session. And then, as I mentioned last week, we've got Master Investor coming up if you actually want to meet us in person. So thanks very much for listening in today, and I will see you all again next week. Bye-bye.